All right, let's talk about supply and demand. So basically, supply and demand is how the market moves. When demand is taking control of the market, price is trading higher. And when supply is taking control of the market, price is trading lower. And this is basically how our entire economy works, really. We could use the housing market as an example. When there's a lot of demand for buyers in the housing market, but there's not enough supply, that's typically when housing prices rise. And vice versa. If there's a ton of supply in the market, but nobody's really buying, then supply takes control, and that's when prices usually take a dive, right? So it's a very basic concept. It's really present in our everyday lives, even as simple as something as going to the grocery store. Supply and demand is in everything that we pay for. It's how the world works, basically. So let's take a look at how it affects us with our trading and how we can use it to our advantage in congruence with everything else we're learning within this video course, especially market structure and things like that. So let's dive into it. I have a few notes here that I'd like to go over before we start talking about the actual price chart in front of me. So again, supply and demand zones are the consolidation phase before the impulsive phase in price. So most of you may already know this, but let's go over it anyway. So the consolidation phase is when price is moving sideways, not really making much progress, not really going up or down. A lot of small bodied candles, very indecisional in their nature, small wicks to the upside and downside, just no directional bias overall. And the impulsive phase is when price explodes in one direction. In this case, on GBP USD on the 15-minute time frame, we've exploded to the upside. Okay, so knowing that supply and demand zones are the consolidation phase before the impulsive phase in price, let's map out one right here with current price. So looking at this bullish leg here, price made an impulsive phase, came down, made a little low, broke the recent high here, created a new high, came back down again, and then impulsively took off once again. So within that price action there, we have a significant demand zone that I'm going to highlight for you guys. I'm just going to use the rectangle tool. I'm going to explain exactly how I'm doing this in 1 second. So I'm going to label it D for demand and just extend it to the right a bit, just so we've got some room. So after price impulsively broke through this recent high, right? We have a high, we have a low, price impulsively made a break of structure, as we learned in the previous video about market structure. So we broke that structure and made a new high, and then a new low. And then price impulsively took off again, okay? So let's look at the next point that I've written down here. The zone can only be identified after the impulsive phase takes place. So this is our most recent impulsive phase, those 3 bullish candles right there. And what that left behind is this clearly identifiable demand zone. So that's why I've highlighted it from wick to wick with this rectangle tool. So basically it's from where the consolidation started, that very top wick of the bearish candle, and then I've dragged my tool down all the way to the bottom wick of the next bearish candle, because that's the full range in which price was consolidating within, okay? So that is our demand zone. Now, these zones can sometimes be used for entries, but me personally, with my specific strategy, these zones are best utilized as profit-taking areas for existing trades. We're of course going to learn about my entry techniques in further videos, because we do have a much more precise way to enter trades than this, but this is a very fundamental lesson and it's important that we go over it. So we've now identified the demand zone, and typically when this happens, price retraces back to it at some point, okay? So let's play price forward a bit and see if that happens here. So we're still consolidating up here, creating a new demand zone actually. And there we go. So price trades back into it. So if you really wanted to have just nice safe entries without too much precision, you could use supply and demand zones for entries. You could, for example, set a limit order right at the top of the demand zone. Place your stop loss just below the demand zone. In this case, that would be 15 pips. And as far as targets go, as I mentioned in the last part here, these zones are best utilized as profit-taking areas for trades. So you can use, instead of a demand zone, you can look to your left and find a supply zone, and you can set your profit target there, and your trade will automatically close out once you reach that area, right? So let's look to the left and see if we can find a supply zone, a significant supply zone that has been unmitigated. And by unmitigated, I mean price has not traded back into it just yet, right? So when price was back here still, this demand zone was unmitigated. Now, as soon as price traded into it, that is confirmed as a mitigated zone. That means it's no longer of interest. It's no longer a point of interest. Price has already mitigated it. So we can now move forward, and equilibrium has been restored in the market between buyers and sellers, right? So again, let's look to the left and find an unmitigated supply zone. So we have supply in a lot of areas here, right? Like there's a lot of places that we could look at, but one that stands out to me the most is actually this right here. I'm gonna label it supply. And the reason that stands out to me the most is because it was never mitigated. You see, price pushed away impulsively from that consolidation phase right here. We pushed away from it very impulsively and then traded back up, but didn't quite reach that zone. So this is still an unmitigated supply zone. So this could provide a great area for taking profit. So if I just drag that over to the right, just so we can visualize it a bit better, we can then set our target to the beginning of that zone, right? Now, again, this is a very small trade. It's only 3.38 return. Usually my trades are double or triple than that. We get much tighter entries with our entry system, but this is just an example, right? So you have a 15 pip stop loss, just over 50 pips of a take profit target, and a 3.38 risk to reward ratio. As you can see, the trade would have been triggered in with very minimal drawdown. Let's just play it forward. And there you go. Would have been a nice, quick and easy profit within a very short amount of time. So it's just a very basic concept. Some people trade this just on its own, to be honest. Like I said before, we have a much more precise way of doing things. So we're going to go over that in future videos. This video is going to be quite short. So there's really not too much to cover because our entry system is going to go over much more in-depth ways to enter trades. And yeah, so let's go over one more example in a bearish market, and then we'll move on to the next video. All right, so let's take a look at a bearish example now. So we're still on GBP USD on the 15-minute time frame. And in most recent price action, what we can clearly see is this very impulsive, high momentum movement to the downside. So first things first, we can mark out a break of structure because we had a low point here that has clearly been violated. So let's just label that on. So now that we've located a proper break of structure, we're looking for a retracement in order to look for a trade entry, right? So what occurred directly before this high momentum move? Well, there was a very tight range of consolidation just above it, right? This was the last point of supply before price gained enough bearish momentum to head to the downside and break market structure, prompting us to look for a pullback and bearish continuation. So if we use our handy rectangle tool, use the supply template, we can mark out this consolidation range as our supply zone. Okay, so I'm going to start from the very top wick of that bullish candle because that's where price first started consolidating and started moving downwards, upwards, downwards, upwards, downwards in a very tight range. And I'm going to drag it to the bottom of that bullish wick right there because that's the lowest point within the consolidation range. So it's very simple. You literally just cover the top and the bottom of the consolidation range. That is your supply and demand zone, right? In this case, supply. So I'm going to drag it to the right just so it's very visual. And like I said, we had an impulsive movement. Now we're going to anticipate a pullback into our supply zone and we'll see what happens from there. So let's play price forward. Okay, so we've tapped into our supply zone. Now, again, this isn't my entry style, but let's just put a risk entry here, which is basically when you set a limit order and place your stop loss just above. So as soon as price enters that zone, you're triggered into the trade. So 20 pip stop loss, much larger than I would prefer, but this is just an example of how you can utilize this knowledge if these supply and demand entries is what you'd prefer. So we can target the most recent lows for 3.5% or 3.5 risk to reward ratio, because down here, oh, that didn't work. Down here, we also have a very tight consolidation range, so we do have a demand level within that. So if we break out the rectangle tool again, change the template to demand, we can map out our demand zone. Now, just to keep things a little tighter, I'm going to go from the bottom of the wick here, which is the absolute bottom of the consolidation, and I'm just going to take it to the top wick of this candle here. So that's a tighter consolidation, right? We don't want to, I'm not going to extend it all the way to the top here because that would be crazy. We'd have a very poor risk to reward ratio trade. So we're certainly hoping that price makes it down towards the most recent lows. But you know, if you really wanted to be safe in this kind of scenario, you could put your take profit level right there at the top of the demand zone. Now that, again, that would be a very poor risk to reward ratio. In future videos, we'll teach you how to get much tighter entries with a much tighter stop loss, such as like a 5 pip stop loss or sometimes even less. But just for example's sake, we're going to have a 20 pip stop loss entry at the beginning of the supply zone, or sorry, at the lowest point of the supply zone. And we're actually going to take the take profit at the most recent low point here, okay? Let's just rein this back a little bit so it doesn't get in the way. And let's play price forward. Okay, so the zone is respected. We have another break of structure to the downside, which indicates that the bearish trend is healthy, at least for the time being, and headed towards the next level of demand. Another break of structure, right? Because as we went over in the market structure section of this course, we're in a downtrend market right now, a bearish market, so we need to see lower lows and lower highs. There's a lower low, lower high, another lower low, lower high, price breaks again and creates a lower low. And that new lower low hit the take profit level as well. Let's just drag that over. Yeah, there we go. So it hit the take profit level. Again, not a very good risk reward ratio. 3.5% is extremely small. That's not what I'm aiming for. Within my entry parameters, I have much tighter stop losses. I'd probably be targeting the same area, but with, you know, more than half of this stop loss size. So it would be much smaller and a much better risk to reward. But again, we'll go over the exact entry types in later videos. This video is basically just to grasp the concept of supply and demand so you can start mapping it out on your charts. And in further videos, we're going to go over refined ways to look for supply and demand, and also better entry systems to do with supply and demand as well. So let's continue to play price forward. I want to see what happens here with it. Okay, so we go much further down. So technically we could have targeted another demand zone, probably on a higher time frame. It would be more visible to the left, but that's completely okay for this example. And as we're going on the way down here, we can see that there's more supply zones being created, because remember, supply is when bearish momentum is in control, right? Prices head to the downside. So we have many supply areas created on the way down. Got another one here, right? Supply is being created all over the place. Let's keep playing price forward and see what happens. Okay, we start trading higher. Slight reaction to this supply zone right here, but not significant enough. Okay, so right here, this is a very interesting zone right here. So I'm going to place this supply zone back on the chart. And this is another great example of supply zone mitigation, because price was just moving along and then it tapped into that supply zone and started to drop off from there. So again, if we go through this exercise one more time, even if we just use a limit order at the beginning of the supply zone, stop loss just above, even if we wanted to just target the recent lows for another 3.25% to add to the 3.5% over here, we could easily do that. And is it respected? Let's see. Yes, it sure is. All right, so there's a few good examples of how to utilize these supply and demand zones. And it's within these supply and demand zones that we actually further refine and get much, much more accurate, precise, very tight entries with tight stop losses and massive risk to reward. So with these sort of trades, they should be anywhere from 10 to 20, like a 1 to 10, 1 to 20 risk reward ratio. So this is just an example to go over the basics, and I hope you guys got a good understanding of it. Supply and demand is a very important concept to grasp, and it's the foundation for things that we're going to learn a little further on within this course. So again, hope you guys enjoyed this video, and stay tuned for the next one. I'll talk to you soon.